Lance from ThetaTraders.com. This video I'm going to go over when to sell cash secured puts, and this is for long-term positions. It's not necessarily for trading. This is when I'm going to be wanting to enter into a position at a discount, and I'll show you the reasons why. So what is a cash secured put? That is a put option where you sell with cash set aside to buy your stock if you're assigned. So let's say a stock's at $50 a share, you want it at a discount, and you sell a 45 cash secured put, then you have to have 45 times 100 for your shares, or $4,500. This is great for investors who want to buy shares cheaper than the current price. You get paid a premium up front. So let's say you sold a 45 put and you took in $100 for that. That money goes right into your account, and you keep that money no matter what happens. You can think about this as getting paid to wait for a stock to drop to your preferred entry price. Here's my core criteria when I sell a cash secured put. I want to sell them when the stock has strong fundamentals. I've done plenty of videos on fundamentals, and there will be more in the future, so subscribe to the channel if you haven't already. RSI, Relative Strength Index. If it's oversold, typically under 30, there's a good chance for a recovery there, but you can still sell at a discount from it as well. And if you happen to get assigned, perfectly fine. If you don't get assigned, then that's fine too, because you took in that premium. These situations, I'm perfectly okay with any scenario. If you happen to get more shares, good. If you happen to get more premium, good too. Want to be willing to own it long term. So just because it might be in a downturn, there might be continued downturns, you're just trying to get that stock at a discount. And you have to be happy buying it with the strike price that you give. Now, why do fundamentals matter? This protects you in case the stock gets assigned. Good companies tend to recover from dips. If you look at a lot of the meme stocks, they might be doing well for a while, then they have a bad earnings or bad news, and it drops a bit, and it'll never recover. And the market's open. Focus on businesses with growing earnings, healthy balance sheets, competitive advantages, and this turns a short-term options trade into a long-term investing opportunity. Goal is to get into a stock or ETF that you like at a good entry price. Now, why RSI below 30 is a good signal? This means that the stock's potentially oversold. Often signals short-term fear or market overreaction. Just because the stock has good fundamental earnings, technically it might be in a low RSI. It might be dipping more than it probably should be. And then you want to take advantage of that because it could give you an edge by buying low and then selling it much later on, in these cases, higher. Here's an example of AMD recently. So if you look at AMD, fairly strong fundamentals. They are a growth company. They do have pretty high valuations, but they are growing and their earnings per share are doing well in general. If you look at the low here, this is when the RSI was under 30, 46, 48. Around here could have been a good time to enter a cash secured put. So let's say I sold the put at 75 instead of 76. It did go up immediately after. If you sold near an at the money put in this case, you would have got a good amount of premium, and then it would have expired worthless. This other opportunity, like right here, RSI got to under 30. Let's say I sold a cash secured put around here. Maybe you would have got assigned over here. But then you got assigned, you got a lower entry point than where the stock was before you sold it. And you also took in premium by doing so. So in this case, it's like a win-win. Eventually, as you can see, the stock recovered quite a bit from this low point. So now what happens at expiration? If stock stays below your strike, you get to keep the full premium. You want to make it so that the cash secured put option you're selling is worth it compared to how much money you're putting up. So if you're selling a 45 cash secured put, you need $4,500 to do it. you want to make sure that the premium is adequate for that amount of funds that you're holding up. And there's no real right or wrong answer to that. It's based on your risk return preferences. If a stock drops below your strike, then you're just going to buy the stock at that strike price. And remember, you're taking in your premium, so you subtract your premium. And now you own the shares of the company that you already believe in. One of the keys is to do this on stocks that you believe in the long term. So why does this work? This helps build positions gradually and at discounts to the current price. No matter where you sell, by the way, it will be at a discount. If a stock's at $80 a share and you sell a put at 80, technically it doesn't sound like a discount, but remember you're getting a lot of premium from it. You can even sell higher than 80. Let's say you sold an 85 put, you would be taking in a lot of premium in that case because it's higher than the current price. So you're always going to be getting at a discount. That's the theta decay when you're selling an option. This helps avoid emotional buying during volatile markets and turns your short-term volatility into a long-term opportunity. So again, if you're interested in more of these, subscribe at YouTube channel. You can also look at thetatraders.com for more information. I go over all my long-term investing and different covered strangles, which is a cash grid put and covered call together. Look forward to seeing you guys in the next video, and I'll see you on the next one.